Hi everyone, I am here today with Shawn Pinto. Shawn is a award-winning mortgage broker with Shawn and Associates, and Shawn has joined me today. We've actually done a few of these videos, informative videos before, but Shawn is here today to lend his expertise to answer some common mortgage-related questions. So thank you so much, Shawn, for being here and helping us out. These are just some common questions that I run into in my day-to-day experience working with clients. And also I just put out a question on my Instagram and allowed people to submit any specific questions they had. So we'll cover those as well. So thank you again. And I hope that this is informative for everyone that's watching. So I think one of the common things that I come across, and a good place to start, is with the stress test. So if people haven't, if they're first-time buyers or they haven't moved, say in the last few years when the stress test was introduced, people are often, they may have heard of the stress test before, but they're not really aware of exactly what it is. So how do you best explain what the stress test is and who it impacts?
Fiona, that's a great question. And since 2017, I've actually had a lot of clients who, as you've mentioned, they're either first-time home buyers or they're clients who have bought and sold a lot in the past, but are now kind of, confused when they have to deal with the stress test.
Yeah.
So the stress test was put in by the government to really do one thing, to limit the amount of your total income that's going towards your mortgage. Okay. So what that means is it helps in the scenario where your mortgage rates rise suddenly or your income drops suddenly. So for example, where COVID has come into play now, where some people's income has dropped, the stress test actually helps limit how much of your total income is going towards your mortgage. So it is a cap on how much you can get for a mortgage, but it's not actually the amount that you pay for your total monthly mortgage rates.
Yeah. So in simplest terms, it's a test of what you can afford should rates go up at any time during your mortgage term.
Correct. Yeah. Should rates go up significantly, as a matter of fact, or your income drops significantly. Okay, so the stress test is tested at a rate that is way higher than where you could actually get your mortgage amount.
Yeah.
So it would have to be a significant jump in interest rates before that would actually be in effect for you.
So who is that impacting? Is there a way to get around the stress test?
At the beginning, when the stress test came in, it actually only people who had insured mortgages. Okay, so somebody who put less than 20% down as a down payment and got an insured mortgage, they were the ones who who fell under the stress test rules. Now the stress test actually applies to everybody. So all the big banks apply the stress test. There are certain lenders out there, some credit unions and some other lenders, that actually do not apply the stress test. However, those rates are slightly higher. When these credit unions and lenders are doing a non-conforming mortgage, which is something that the stress test is not apply, it's considered slightly higher risk. And the way they mitigate for that risk is to actually charge a slightly higher rate on the mortgage. So yes, that is available.
Okay, great. Another common thing that I run into is the difference between down payment and deposit. So I often find people are very aware of the down payment. They are aware that they need to have some money saved up to put towards their mortgage, but can often be surprised, and I always like to cover this at the beginning with my clients, but they're often surprised when I do cover it, what the deposit is. So can you just explain the difference between the two and how those impact the mortgage?
That is a great question, something that comes up a lot for us as well when we're dealing with clients. There are really two different times in the mortgage process. I'll go through the whole process. So a client goes out with you, Fiona, they're out there looking at a home, they find that a home they like, and they're putting an offer on the home. The offer gets accepted, and generally speaking, they have about a week to 10 days to take those subjects off. The deposit is the amount you put in to let the seller know that you are now going to complete that purchase. So that's the deposit amount.
Yeah.
The deposit amount is generally 5 to 7% of the total purchase price of the home.
Yeah.
And forms part of the final down payment.
Mhm.
The down payment is the amount that you have to put down. And then now your lender, which is your bank or credit union or whatever it is now going to give you the rest of the mortgage amount. So the down payment is the portion that you have to put down to complete the purchase. You obviously get the mortgage for the remainder of the purchase price.
Yeah. Okay, great. And what happens if somebody doesn't have those funds up front? So say they have a $45,000 deposit due, and it's usually due at subject removal or within 24 hours of subject removal, whatever is stated in the contract. And not a lot of people have that money sitting in their bank. And if they don't have family and friends that they can borrow it from, where do you go to get your deposit funds?
Also a good question. In the scenario that somebody has completing a transaction where they're selling their home and buying a new home, the sale of their home they've had subjects removed on the sale of their home, but that sale has not been completed yet. There are lenders out there who will lend money for the deposit based on knowing that you have an accepted offer on the sale of your home. So there are definitely lenders out there that can help out with that. There are fees, of course, to obtaining those funds.
Yeah.
But there are definitely lenders out there who help out with getting that deposit amount in that scenario.
Okay, so a short-term loan, it's not free.
Exactly.
Okay.
Exactly.
Great.
Yeah.
Okay, so another question is just around income and improving your overall mortgage amount. So a lot of people that are paying strata fees I always get asked this question, like, what do the strata fees translate to in terms of mortgage amount or rental income? Like if they're going to purchase a place that has a rental income, is that going to be able to afford them a bigger mortgage?
I'll go over the rental income thing first. And the way I'll explain that for your clients, something that make it easy is in current lending scenarios. If you make $100,000 in income, that qualifies you for a mortgage of about $600,000 based on a 30-year amortization and based on you having no other debts at all and having good credit. Okay, so for an average client, if you're earning $100,000 in income and we can use a 30-year amortization, you can now get a $600,000 mortgage. So if you think of rental income, most lenders allow you to use 50% of the rental income that you earn. So if you have a basement suite or an apartment, that's earning $19,000 a year in rental income, or let's say 20,000. Let's keep round numbers. 20,000 in rental income. 50% of that would give you $10,000 of total income. So $10,000 of total income would now add $60,000 to your mortgage amount that you would qualify for.
Okay.
So in the scenario where someone earns 100 and has
this is what working from home is all about, right? We get the background noise. Keep going.
If someone has 100,000 in total income and they would qualify for a $600,000 mortgage, adding an extra 10,000 in rental income, which is 50% of their total rental income, would qualify them for a mortgage amount of $660,000.
Okay. Okay, good. That's helpful. And it sounds like the numbers are all pretty specific. Like that's a very general example. So if somebody is in that situation, best to speak with a professional such as yourself to get a more adequate idea of what it is that they could afford.
Exactly.
Yeah.
Exactly. Because again, it depends on somebody being able to do a 30-year amortization. To be able to do a 30-year amortization, you need to have 20% of your down payment.
Yeah.
So there are definitely specifics to that. So it would be good to speak to your bank or your mortgage broker about those specifics.
Okay, great. Another question that came up was around how difficult is it to get a mortgage if you're relocating and if your job is changing? So can you speak to that a little bit?
That's the question, again, that's very specific to the individual client. So in the scenario that you're relocating and going to a similar job, okay, and your income is going to stay the same, You're not going to a place that you're going to have a long probationary period.
Mhm.
Lenders are fine to lend you knowing that you've been in the industry for a while and you're going to maintain the same type of job and the same income. So lenders are comfortable with that. But again, it's very specific to the situation.
Yeah.
If you have somebody that is highly skilled, person who's going to a new job, where even if they had a longer probationary period, their skill set would allow them to get a different job quite easily. Lenders are also comfortable in that scenario, lending to people.
Okay. And if that doesn't apply, if they're going to a different job, then again, I would say that they just need to reach out to discuss their specific situation.
Exactly.
Yeah.
Because those ones become very specific, very individualized in terms of what the banks really want to look for is the totality of the whole deal. So not only is the job and the income very important, it's the sustainability of that income that is very important as well. So if it's a transferable skill where you're going to a certain job, but that skill is transferable to different jobs and makes you, easily employable, that's something that can definitely be used for income, even if you're switching jobs.
Okay, awesome. Thank you so much. That kind of finishes up our questions. I really appreciate that. I think this is going to be valuable for those out there that are considering moving, that haven't, done it in a while, or it's their first time. And I also just wanted to finish it up with saying if they are thinking of moving, and what's the best place for them to start? Like, where should they start this process if they are moving and also need mortgage funds to do so?
Well, I'd hope they'd start with me or a mortgage broker of their choice, but they can definitely start out with their bank as well. The way to do that, Fiona, is really go down to your mortgage broker, go down to your bank, speak to them, and they're going to ask you a series of questions. The questions are around income. So what kind of a job are you doing? How long have you been doing the job? How much income are you earning? The questions are around down payment. What kind of a down payment do you have? Once they get those documents down and they know your income, you can get pre-qualified for a certain amount of mortgage. Once you know how much mortgage you're qualified for, you can reach out to your realtor, get around, start looking at homes, and make sure that you find a home that you like within the price range that you're qualified for. So that's a great place to start, is talk to your mortgage broker. Give me a call if you'd like. I'd be most happy to answer any questions, or talk to your banker and then start from there.
Awesome. And what is the best way to get a hold of you?
I can be reached on my email, and Fiona, we can post that email here in just a bit at shawnpinto@invest.ca, or on my cell phone, 778-228-0112.
Awesome. Thank you so much again, Shawn, for joining us today, and I hope you have a great day.
Thanks, Fiona. You as well.
Bye.